Hi, Robert and Austin. Big fan of the show. I'm married and I have a 3-month-old, so I'm looking to buy some life insurance. I was planning on buying term life insurance, but I heard a presentation from a financial planner about permanent life insurance, and it has me thinking that it could be a really good idea. A bit of my financial background is I work in the medical field and I take home about $500,000 a year. My 401k is fully funded by my employer, and my IRA and HSA accounts are maxed out. I have $500,000 in my bridge account. I also have a home mortgage of $630,000 and another $50,000 in student loans. The way it was presented to me is that permanent life insurance has the same tax benefits as a Roth IRA, except with no contribution limit, and I can withdraw it at any time. So if I have the extra disposable income, does it make sense to invest in a permanent life insurance plan? What are the downsides to such a plan? Should I just stick with term life instead? Robert, you want to kick this one off?
Oh, yes. I love this.
Let's not be mean to Kevin. Kevin is, I'm sure, just curious. He doesn't know better.
We're not going to be mean, but Kevin and everyone else that gets pitched permanent life insurance, IULs, be careful. Because let me explain the most important factor of all of this. And that is, if you invest in VOO in the S&P 500 for 10 years, the investment grows, it compounds, you're making money, you're growing your wealth, and you stop investing in VOO in the S&P 500, guess what? The money keeps growing. That is it. When you look at whole life, especially these IUL policies, if you have a lapse in payments, your money vaporizes. It's gone. So you have to realize it is not truly an investment in a way that if you said, oh, I can't afford these payments anymore, I'm just going to let that money ride. Well, guess what? The policy cancels, they keep your money, and you're out that money. So that is the biggest thing that I do not like about these. And I don't believe it should even be legal that they're called investment vehicles, because they're just not. Secondarily, they're very, very expensive. And that is the biggest drawback to permanent life insurance. The fees are astronomical. Whenever you get approached by anyone selling you whole life, especially IUL policies, ask them this one question, and it will change your mind and change your life dramatically, because you'll know to say no to it. And that is, what are the fees and commissions relative to the amount of money I put into this account? Because they're not going to want to tell you that in the first 2, 3, 5 years, the commissions can range up to 50% on your money. And if there's one thing that boils my blood, is the person helping me with my money should not be making more with my money than I make. So important. So those are the two things that piss me off the most, because these people, you see all these guys on Instagram and TikTok talking about how more millionaires are made being life insurance agents. Well, guess what? If you can sleep at night ripping people off on their money, then I feel sorry for you, because at the end of the day, I want people to invest for their futures using the right vehicles so they can retire with dignity and peace.
Mic drop. I'm right there with you, Robert. Let's kind of break down real quick, just so we're on the same page, the main differences between term life and permanent life. So term life insurance is very straightforward. It's what I have. I pay, I believe it's like $1,600 a year. I've got a couple $1 million. I've got Prudential, I think is who I have mine through. It's a 10 or 15-year policy. I'll have to check. But essentially what that means is, if I die, my beneficiaries will receive this lump sum payment of, let's call it $2 million. And they can take that $2 million and replace the income that I was creating with that $2 million by investing it in the markets and pulling out 4, 5, 6%, whatever they want to do. Life insurance exists to supplement the income of the survivors. Okay? Now, that's the term life insurance policy. After 10 or 15 years, whatever, if I don't die, cool, the money is gone, yes, but it's also very cheap. I think it's like $80 a month is what I pay for it. It's pennies compared to the amount of money that my beneficiaries will get if something bad happens to me. Now, on the flip side of permanent life insurance, instead of $80 a month, it's $800 a month. And so you're still paying for that, let's call it $2 million policy. But here over on the side is where it's the investment. They say, yeah, we'll take a little bit of this $800 and we're going to invest it for you. And we're going to index it to, let's call it the S&P 500, which in actuality, they index it at 4 or 5% or something. The S&P did 28% the other year. So get out of here. And it's indexed, it's growing a little bit and everything else. And then once that amount has grown a little bit, it and you want to enjoy your investment, you now have to borrow it as debt and then pay it back before you die. So, Robert, I've never heard of an investment that I don't have. Therefore, I've been paying into it, though, but I can't touch it unless I have to borrow against it. And then I got to pay it back. So it's not even mine to begin with. And it's 10 times more expensive. Just think about how much extra money you could have if you just took that $800 or the difference, right? 800 minus the 80, so the $720 a month, and just invest that in the markets, like you were saying, into the S&P over the next 10, 15, 20 years. You will have much, much more money.
Yeah. And as a reference, a high net worth client and friend of mine showed me their IUL policy that they purchased and have been paying on for years. And over the last 3 years, their average return on this so-called investment was 2.6%.
Oh, God.
So let's talk about that real quick. The S&P 500, what did it do last year, Austin? Like 26%, 25%. The year before, 21%. You're leaving so much money on the table. In really one way that's really kind of comical about these accounts too, is it's almost impossible to figure out what the fee structure is, and these companies do it intentionally. If you look at one of these contracts, it's like 35 pages long, and it is very difficult. You would need to be a rocket scientist or possibly an accountant of 30 years to be able to even break it down and understand the fee structure. So we like to keep it simple, stupid. We like your money to grow and you have autonomy and understand what you're investing in, and whole life policies are not the answer.
So, Kevin, here's what you do. You go get a term life insurance policy where the death benefit is 8 to 12 times your current annual income. That will give you enough flexibility where your survivors will be able to invest the money. They will then be able to withdraw 4, 5, 6% out of it every year and replace your income with this investment lump sum.